Okay, so now we have two types of bonds, um, non-coupon bonds and with coupon bonds. Okay, and we also have learned two things. If your YTM is equal to your coupon rate, will the bond be trading at par, premium, or discount? Anyone? Okay, if I put it like that, if the market interest rate, it means the interest rate in the market and the interest rate that the bond is offering, if they are equal, so will the bond price be trading at par, premium, or discount? Anyone? If they are equal, okay,
Is it par, sir?
par, very good. So it will be trading at par. So please don't get confused with YTM. YTM means the return that you can get in the market. Okay, coupon rate is the return that bond is offering you. Okay, so this is called a market return. If you invest your money in some other investment, this is what you will get. And coupon rate is the rate that the bond is offering. So if market is offering you greater than the coupon rate, then the bond is offering. Then if market is offering you more than the coupon rate, so will you be happy to buy this bond at 100 or 1000? No, you will say, sir, since market is offering us higher rate of interest than this coupon rate, so we are not going to pay 1000, because if you invest this 1000 somewhere else in the market, you will get higher interest rate, but coupon rate is giving you, but this bond is giving you less. So will that be bond trading at discount or premium or par? Will you pay 1000 for such bond? Anyone? Okay, if you are not able to understand this, so this is the way to remember it. Okay, 1 plus YTM power n. So if YTM increases, then price should increase or decrease? Decrease. So this bond will be trading at discount. Okay, so if market is offering you less than what this bond is offering you, so by investing 100 in the bond will give you higher return than if you invest 1000 in the market. So this bond will be trading at premium because the demand for such bond will be higher. Okay, so this is the rule that you should remember, and you will see that when we will solve the questions, you can simply straight away get this information correct. Okay, so let's say the yield to maturity of a 1000 bond with a 6% coupon rate, mean this is the rate that the bond is offering, and the price or the face value of the bond is 1000. Semi-annual coupon mean this will be paid every 6 months, and 2 years to maturity, n is equal to 2 years, 8.5% APR compounded semi-annually. I told you last time that when you see this compounded, it means that we have to convert 8.5%. Okay, so n is equal to 2. Since it's semi-annual, we will multiply it by 2 to get 4. YTM mean market interest rate is, or market return is 8.5%. Since it's compounded semi-annually, so we will divide it by 2. And coupon payment, how do we get it? Coupon payment is equal to face value multiplied by what this bond is offering. It means coupon rate. So 1000 multiplied by 6.5% will be 650, will be 65. So if you divide it by 2, so it will be semi-annual payment. Okay, so instead of writing the individual formula, so you can write, you can also calculate this answer using annuity. Okay, so it means that what will happen every year, every 6 months, for how many periods? For 2 years or 4 periods, you are going to get 32, 32, 32, 1, 2, 3, 4. Okay, so that's all. So it means you will get 32, 32, 32, 33, 2 for 2 years. It means 4 payments will be 1, 2, 3, and 4, plus when the period will end, you will also get your principal back 1000. So it means the last year it also needs some adjustment. Okay, so you can apply the formula of present value of annuity is equal to C is 32 divided by coupon payment divided by rate, that is 0.85 divided by 2, that is 0.0425. 1 minus 1 over 1.0425 power. What should be the power? Anyone?
Is it 4, sir?
Very good. 4 plus, because you will also be getting 1000 at the end of the period. So it will be 1000 divided by 1.0425 power 4. Okay. So this way you can calculate the value of a bond. Okay. And if I just hide this information, and if I ask you, I'm not showing you the answer. By using this information, can you tell me whether the price of this bond be at discount, premium, or par? Can you tell me? Coupon rate is how much? 6.5%, right? YTM is equal to how much? 8.5. Yeah, so will that bond be trading at par or discount or premium?
Is it premium, sir?
Sorry, come again?
Discount,
Is
sir.
it premium?
Okay, so one is saying premium, one is saying discount. So if you're not able to understand that, so remember this formula, C divided by 1 plus YTM. Okay, C is the reflection of coupon rate, YTM is the reflection of market interest rate. Okay, so it means that if your YTM is higher than your coupon payment or coupon rate, then it means if the denominator is higher than the coupon rate, then the price should increase or decrease. If I increase the YTM, will the answer
Decrease,
of the T increase or decrease?
Decrease.
Decrease. Very good. So since in this case our YTM is higher than coupon rate, in other words, our denominator is higher than numerator, because this 32 is, we receive this coupon payment by multiplying this 6.5 with 1000. So it means this shows the coupon payment. So it means the bond will be trading at discount, because people are requiring more. How much more? They are requiring 8.5%, but the bond is offering you 6.5%. So you will not buy this bond at 1000. You will be buying this bond at a discount. So if the company or if the market is giving you this bond lower than 1000, then you may buy, but how much should be the price? That is 963. So it means that with the given coupon rate and the market interest rate, this bond should sell at 963.91. So please remember this statement. This bond should sell, I'm saying, not should sell. Okay. So it means that the actual, or in other words, the fair value, in other words, we can also call it as fair value. The fair value or the actual value should be 963.91. So this is according to your calculation. Okay, but the market situation could be different. So let's say in the market this bond is selling at 900. Okay, so will you buy that? This is market price. Will you buy that?
No, sir.
Okay, so let's say in your mind, so let me export it this way. In your mind, you have calculated, because you have learned the financial mathematics. So you know that you can calculate the value of anything. So in your mind, the actual price should be how much? It means that you are willing to pay 963.91 to buy this bond. But when you go in the market, the price is 900, right? So will you buy it?
No, sir, because it's more expensive.
Okay, very good. So let me explain that. So let's say you are going to you are interested to buy a phone, right? So the price that in your mind about some iPhone, used iPhone, is, let's say, RM 2000. Okay, so this is maybe 1 month used some phone is 2000. That is the maximum that you can pay, right? So this is similar to your calculation that we have done here. So it means the maximum that you can pay is 963, because this is according to your calculation, right? But when you go to the market to buy this bond, the sellers, there are different sellers who are paying, who are selling the similar phone that is 1 month use. This seller is selling at 2100. This seller is selling at 2300, and this seller is selling at 1800. From which seller would you buy? 1, 2, and 3. Which seller will you buy? Will you go to buy your phone?
3, sir.
3. Why? Because you say that in the market, right, situation is different than you were expecting. You were expecting that the price should be 2000, right? This is your maximum price that you can pay for this kind of phone, right? But in the market, you see that this bond, you were actually willing to pay 2000, but this seller is willing to sell at 1800. So of course you are going to buy this one, right? Correct? Correct?
Correct, sir.
Okay. So in other words, this is the market price, real market price, and this is the should be the price. In other words, this is the price that is a fair price that you think. Okay. In other words, this is also called the intrinsic price. Intrinsic mean you calculated this price based on some calculations, right? But this is a market price. So what do you call have? So you will say, sir, according to my calculation, the price should be 2000, but in the market, when I went to buy this phone, the price was 1800. So can I call this price as underpriced? Can I call it?
Yes, sir.
So you will say, sir, actually this phone was underpriced in one of the shops, so I bought this. But if I ask you, would you buy the phone from these seller 1 and 2?
No, because they're overpriced, sir.
Overpriced. Very good. So they are overpriced. So let's put this situation in a different way. So in this case, you are going to buy, right? It means you do not hold this phone. So let's say you are going to sell this phone that is 1 month used. Okay, the situation is now reversed. You have a phone that you want to sell. Okay, so it means that this is the price you are willing to sell. So this is the minimum that you can go, right? Below this 2000 you are not going to sell. But when you go to the market, you see that this is, these are the situations. Okay, which seller would you go, which buyer would you go to sell your phone? 1, 2, or 3?
Can you repeat the question, sir?
Okay, so let's remove this part. Okay, so it means that you are going to sell your phone. You think that the actual value or the fair value of this phone is 2000, because last month you bought it for 2500 and you used it for 1 month and you are excluding a 500 depreciation. So according to you, the price should be 2000, right? Correct? Now you want to sell this phone in the market. When you go in the market, the price that you got is 2300 in the market, right? So when you went to the first shop and you tell them that I want to sell this phone, they ask you that, okay, we are willing to buy at 2300. Would you sell your phone?
Yes, sir.
Okay, so and why, what would you call this 2300? You will say, sir, this is a market price, number 1, and number 2, is this an overvalued phone or undervalued?
Overvalued.
Overvalued. You will say, sir, since it is already overvalued, overvalue means actually its price is 2000, but in the market it is overvalued. So in that situation, would you buy, would you sell it or not? Would you sell your phone?
Yes,
Yes.
sir.
Yes. So it means that when things are undervalued, what do? You buy, right? Okay, because previously you were willing to buy the phone at 2,000, but in the market the price was 1,800, because you know after some time its actual worth is 2,000, but in the market it is 1,800, so you will buy that. But if an asset is overvalued in the market, and if you have the asset, what would you do? You sell it, correct? Because the price later on will move towards its principal. Let's take another situation. Let's say gold. Okay, during the corona crisis, what happened? Did the gold prices increase or decrease? Let's say, may I ask you, what is the 10-gram value now? Let's say, let's make an assumption. Anyone? RM. So I'm putting any value, so it could not be realistic, but let me put it 500, right? Correct. So let's say the actual price, or the 10-gram price of the gold before the crisis was 500, but when this corona came, we knew that the gold prices, they decreased because the people had less money to consume, because they had no other earning, so they sold the gold. Okay, when they sold the gold, the supply of the gold increased in the market. When the supply increases, price increases or decreases? Decreases, right? So it means that the gold was trading at 10-gram gold was trading at, let's say, 350. Okay, so my question to you is that because of some crisis, the price went to 350. So this is the market price. But is that the actual price of the gold?
No, sir.
No, because the actual price is how much?
500.
500. You know that because of some certain situation, the price is currently down, but a fair value of this gold is 500, right? Okay, so if you have cash, would there be any opportunity to buy this gold at this price?
Yes, sir.
Yeah, you will buy this bond. You will say, hey, I mean, the bond is currently undervalued. The gold is currently undervalued. So try to invest in the gold, because later on, when the crisis will relax, I mean, things will be okay. It will revert back to how much? 500, right? Correct?
Yes, sir.
Yeah, so it means that in this situation, this is a concept of undervaluation. Undervaluation means that currently its price is low, but after some time its price will increase. So if I invest now, I will buy it for 350. Later on, I will sell it at 500 when things will be okay. So I will earn a profit of 150. So this is what it means, that during some in the market may not evaluate something properly, so it is undervalued. So you buy the undervalued thing because you know that the actual value is 500, and you invest in those securities that are undervalued, because you hope when the price will increase, you will make profit. Okay, so this is a situation here in this bond as well, because if you see, 8.5% is the market interest rate, 6.5% is the coupon rate. So the price is 963.91. So this is the fair value. But if in the market the price is 900, you will say, sir, this is similar to gold, right? Currently, this bond is trading at 900 because it is undervalued. Its actual price should be 963.91. So would you buy that or sell that if you have? if 900 and 963 is the situation, first of all, can you tell me whether this is an undervalued bond or overvalued bond?
Undervalued.
Undervalued. Would you buy that?
Yes.
Yes. Why would you buy that? Because you know that in future its price will increase from 900 to 963, or maybe some 970 or 9 something, right? But this is not the actual value. It is just because of some market conditions. So that's why the price is like that. Okay. So this is situation number 1. I hope you got this. So now when we will see other questions, it will be very easy for you to understand. Suppose a 7-year 1000 bond, 7 years means 7 years is the maturity, with an 10.46% coupon rate. Okay, and semi-annual coupon is trading with a yield to maturity of 8.7%. So it means that this is again a similar situation. 8.7% is the YTM and 10.746 is coupon rate. So just from this information, you can tell us whether this bond is trading at premium or discount. Can you tell me?
Premium.
Premium, because our YTM market interest is lower than what this bond is offering. So that's why this bond should be selling at premium. So that's why it is our first answer is that this bond should be trading at premium. Okay. So just to confirm, okay, I mean, yeah, and you can also do the calculation. In this question, they did not do the calculation, but if you want to do the calculation, you can do, since in the second part, we wanted the calculations. So I'm really sorry. Yeah. In the second part, we need to do the calculation. So what is happening in the second part? Our YTM changed from 8.7% to 9.54%. So YTM increased. So it means again, this bond should, but still it is lower than the coupon rate, right? So, but still this bond is trading, should be trading at premium. So how do we calculate it? Same formula you can do. Present value is equal to C divided by YTM. 1 minus 1 over 1 plus YTM power n plus face value 1 plus YTM power n. Okay. Coupon payments are semi-annual. So 1000 multiplied by 10.46 will give you, you can do the calculation. Whatever is the amount, you divided by 2, you get 52.3. And this this 9.54% will also be divided by 2 because semi-annual. And since it's a 7-year, so multiplied by 14. Okay, so this is the coupon payment. This will be your YTM. N is equal to 7. FV is equal to, F is 1000, and YTM you also know it is 4.77%. And when you do the calculation, your answer is 1046.21. As you can see, your face value is 1000 of this bond, but the market price is actually 1046.21. Sorry, it should be 1046.21. Okay, so this is the maximum that you are willing to pay for such bond. Okay, so if I write this information, the answer is $146.21. So you will tell me if I'm stating it correctly or not. Number one, if I ask you, this is called the fair value, is it correct? Please be fast, huh? Is it a fair value?
Yes.
Okay, is it an intrinsic value?
Yes.
Okay, so it should be the value at which the bond should be trading.
Yes.
Okay, perfect. So now if I ask you, this is the from a buyer perspective, if I want to invest, is it true if I say that this is the maximum price at which I am willing to buy? Is it correct?
Yes.
I'm not paying a penny more than 1046.21. Is it a correct statement? As a buyer, I'm not going to pay anything more than 1046.21, correct? This is the maximum price, correct?
Yes, sir.
Okay. Number two, if I'm seller, what should I say? This is the minimum price I would be willing to sell this bond, not less than this, correct?
Yes,
Yep.
sir.
Correct. So it means that if you are a seller, so this is your minimum price at which you are happy to sell. Okay. As a buyer, this is your maximum price at which you are willing to buy this bond. Correct. So you can explain it through two different perspectives, from buyer perspective as well as from seller perspective. Correct. Okay. So from a buyer perspective, if the price is 700, and from the seller perspective, if the price is 1100. Okay, what would be the situation here? Would the buyer buy that? So first, let's make it 700 for both. Okay. So can you tell me, when the market price is 700, will the buyer buy this bond?
Yes.
Yes. And why would he buy that? Because this bond is currently undervalued or overvalued?
Undervalued.
Undervalued. So it means he will buy. How about the seller? Will he sell this bond at 700?
No.
No. So he will say that this is undervalued. So undervaluation is for both. I mean, this is undervalued for buyer, undervalued for seller. Because from a buyer perspective, it is undervalued, he will buy. But seller will sell it? No. You said no, right? So seller is not going to sell it. Seller will not sell undervalued bonds. Buyer will buy the undervalued bonds. So we can reverse this situation. So let's say if it is 1100 and 1100 and 1100. Okay. Now, so this is from a buyer perspective, is it an overvalued bond or undervalued bond? Please think.
Over, sir.
Overvalued. So will he buy that?
No.
No. So he will not buy that. How about seller? What will seller say?
Sell.
He will sell, because what he is thinking, first of all, he will say this is overvalued. Buyer will also say this is overvalued. So for a seller perspective, he will sell it, but from a buyer perspective, he will not sell it. When it is undervalued for both, right? Buyer will buy that, seller will not sell it. Okay. So this is, you should remember. Okay. Please remember that you should not compare this answer with 1000 that is given. Okay. So this is the stated price. This is not the market price. Remember, you do not compare the price that you calculate from the par value. Okay. Don't do that, because that is another value. We should compare it with the market price. Any questions so far? Anyone? No question. Okay. Suppose that GM Motors Acceptance Corporation issued a bond with a 10 years until maturity, a face value of 1000, coupon rate of 7%, annual payments. The yield to maturity on this bond when it was issued was 6%. Okay, so YTM is 6%, coupon rate is 7%. So from this information, we can straight away tell that this bond should be trading at premium or discount?
Premium.
Premium, very good. Now assume the yield to maturity remains constant. So this should remain constant. What is the price of the bond immediately before it makes its first coupon payment? So this is a very important situation you should remember. So let's draw this on timeline. How many payments do we have? 10 payments, right? So let's say this is payment number 1. And when it will mature, how much will we get? We will also get extra 1000 as a face value. So what is the coupon payment every year? Anyone? face value is 1000, coupon payment is equal to face value multiplied by coupon rate. So 1000 multiplied by 7% is equal to 70. Should we divide by 2? No, because this is already annual. So it means 70, 70, 70, and 70. Correct? Correct me if I'm not doing anything right. Okay. So far we are correct.
Yes.
Okay. So 2, 3, 4, 5, and all that. Okay. So question can ask us that what is the price of a bond? Okay, so it means normally question asks us that what is the price of the bond when it has the 10 payments. So simply we do the calculation that we have done before. But here the question is making a different statement. The question is not asking you to do the calculation when you are standing here, correct? The question is asking you, assume the yield to maturity remains constant, that is 7.6%. What is the price of the bond immediately before it makes its first payment? So immediately before means, so let me draw that here. Okay, use the color. Let me use a different color. Okay, so immediately before means this is the time when this payment will be paid, and I'm just standing here. Okay, so next moment I'm going to get, so it means this is my position. Okay, immediately before the first payment means 70 will be paid maybe in the next moment. In other words, some time has already passed. Okay, so it means I'm not standing here, so I have moved from here to, maybe it is the 29th of December or 30th of December. Just one day more is left where I will be getting my first coupon payment. Are you getting me? Are you
Yes.
getting? Yeah, it means that my position is not here. So otherwise it was very easy to do the calculation. Simply we will apply the previous formula. But here the question is saying that immediately before, it means that some period has already been expired. We have moved from our time of investment to maybe 11th month, 11th month, or maybe we are near the completion of the year. We are just here. So it means in the next moment we are going to get it. So it means that very next moment when I'm standing here, I will get 70. Before the first payment mean I'm standing here, and next moment I will get 70. So since the time interval before the first payment is to be paid is very short, so I will not do the discounting of this one. Are you getting me? Are you getting me, students? Since the time between the first payment to be paid in the next moment is just near, right? So I'm not, and when I will receive it, the time period is so short that I cannot discount it. Correct?
Yes.
So it means that first the payment that I'm going to immediately get will not be discounted. So that's why it is C70 plus. So it means that once I will get it, so I will start, it means the first payment is now occurred. So the price should be the present value of the remaining cash flows. How many remaining cash flows are now left? Once I receive this is
9.
already received, right? So how many more are left? Very good. N is equal to 9. So n will not be 10 because n will be 10 if you are standing here, right? So since I have moved a distance from 0 to just near the completion of the first year, and I'm standing there and I'm going to do the valuation. So it's unfair if you do the valuation for 10 years. So that's why you will use 70 as the first payment. You got it. You are not discounting it because the time period is very short. So you will now discount it using how many years, how many payments more? 9. So you will use 70 divided by 0.06, 1 minus 1 over 1 plus 1.06 power 9, right? Plus FV is 1000. Should I do 1.06 power 10 or 9? Anyone?
10.
10. You are saying 10. So it means if you are saying 10, am I standing at year 0 or at year 1?
Oh, 9, 9.
9. Very good. So it means that it should be 9 because my position is not now at year 0. My position is at year 1. So you will get your answer. Correct? Did you get me?
Yes.
Okay. So you can, and is everyone else clear? Can I also hear from some other students? Okay. Anyone? Please turn on your mic to tell. Otherwise, I will keep repeating. Okay.
Yes, sir.
Okay, perfect. Thank you. Now let's get to another situation. So it means that, so since I was about to receive this, so that's why I have added it. So let's say if I have already received it, so how will I treat it? The situation will be different. Assume the yield to maturity remains constant. What is the price of the bond immediately after it makes the first coupon payments? Now the situation is relatively different. Okay, so let me draw it again. The situation will be different in this situation. Okay, so it means that the first payment was to be paid at 70, okay, at here, but now your position is here. Okay, so it means that you have just received your payment, and now, I mean, the payment is now received already, right? In the previous situation, you were about to receive the payment, but here you have already received the payment, right? So it means 70 is already expired. So it is already, it should also, it is already received and it should be discounted. But now it immediately after mean you have just received it and now you want to do the valuation. So your position is now here. So it means that from the, for the next period is maybe on 31st of, or maybe on 1st of Jan, you got this payment, and now it is 22nd of January. So it means that now you will do, you will not add 70. You are not going to add 70. In the previous case, you added 70, but immediately after, you are not going to add 70. The rest of the parts, they will remain same. So it means that your position is still here, but you have slightly moved onward. Previously, you were standing here. Okay, but now you have slightly moved to one period after the payment is already occurred. So it means that you will apply the similar formula, but you are not going to add 70. Are you getting me? So other things, they will remain the same. So in other words, if I write the formula for this concept, so I will write immediately before, what will I do? I will do present value is equal to, let's say before third payment, I will say, okay. Let's say instead of 1, I'm using third payment. So I will use, should I use C2? Or sorry, it will be C3 plus C4. I mean, then C divided by YTM, 1 minus 1 over 1 plus YTM power n minus 1. Correct? In our case, we do what we did actually, we do 70 plus 70, 0.06, 1 minus 1 over 1.06 power, it was 9, right? So that's why it is 10 minus 1, 9, right? So this is C4 if I say, but since they are equal cash flows, so I'm not writing C3 or C4, so I'm just writing C. So it will be C plus C over Y, 1 minus 1 over 1 plus Y, and minus 1. Okay, so immediately before, for any immediately before, so this will be the treatment. For immediately after, what will you do? Will you add this C? Will you do that? So it will be C divided by Y, 1 minus 1 over 1 plus Y. Should I do N or N minus 1, students? Anyone? How many years did we use for our second situation? 9, right? Total were 10. We have already received 1, so it is N minus 1, right? So it was 9, correct? So you will use N minus 1. So please remember that when the question says immediately before, add the cash flow 70, right? Plus the other formula of present value of annuity. So it will be used for 9 periods. So for the immediately after, you see you are not adding 70. So you are just using the remaining formula, this one. Correct? So may I ask you a question? Which answer would be greater? Present value when immediately before, is this answer should be higher than the answer that we will get if it is present value immediately after? Which answer should be higher? Anyone? Please turn on your mic if you want to answer. Anyone?
The before one.
Before one, very good, because we are adding the cash flow. It is C plus C, right? Here we are not using C plus, we are just using C divided by YTM. So that's why the answer should be higher than the after. Okay, you see 1138 and this is 106.8.02. Okay, suppose you purchase a 30 years zero coupon bond with a yield to maturity of 4%. You hold the bond for 5 years before selling it. Okay, so let's draw the timeline. A 30-year bond, so it means 30 years. And you purchase a bond here. So you purchase a bond. Zero coupon bond means there will be no payments in between. So you will just buy the difference. You will only expect the difference. Okay, you hold the bond for 5 years. So let's say you are holding the bonds for 5 years. The total period is 30 years, but you think that you will buy this bond now and you will sell it after the end of 5 years, right? So it means you buy it here and you sell it here. Okay. If the bonds yield to maturity is 4%, YTM is 4%. When you sell it, what is the annualized rate of return of your investment? Okay, so now my question to you is, is there any face value given for this question? You see that, of course, this is a zero coupon bond. Coupon rate will be 0. It's not given. N is equal to 30. What is the face value? Anyone? Face value would be, I told you last time that if in the non-zero coupon bond, if the face value is not given, you will assume it to be 100. You can also assume it 1000, but I would suggest to consume it 1000. Okay, so now you want to, when you had invested in this bond, so what is the price of this bond? So when you will do the valuation, it's a very simple valuation because you just need to calculate the future value. So that's a very simple case. So purchase price mean this is 1100, mean at the end of the period you assume that you will get what, 100, and you had bought this bond and you expect that after the end of 30th year you will receive 100. So if I ask you what is the price, a very simple case, you know that the present value will be equal to future value 1.04 power 30, and you will get your answer. Okay, so this is the answer for the purchase price. Now you will say, sir, why are we not applying the formula of annuity? Because this is a zero coupon bond, right? There are no cash flows here in between. So it means that when you will buy this bond, you will get 100. But then the question comes, why would you buy this bond? Since, you are just getting 100. Can any one of you tell me why would I invest in this bond? Normally these bonds, bonds are sold at discount. Okay. So let's say if I buy this bond, maybe I can get this bond at 800. So what is the motivation? It means that if I invest 800, sorry, I'm assuming. Sorry, I had lost you. Can you hear me?
Yes, sir.
Okay, sorry, I don't know what happened to the internet. Okay, so it means that you have bought this bond at 800 with the expectation that you will not going to get anything in between, and then you will get 1000. So you are expecting a difference of 200. So that's why you have bought this bond. So normally non-coupon bonds, they are sold at discount. So that is the motivation. So it means that after 30 years, you will be getting only one amount, that is 1000. So the difference is 1800 and YTM is 4%. So this is a very simple case of future value, and we will get this answer. We will calculate the present value, right? So the present value is equal to future value 1.1 plus YTM power n. Future value is 1000 or 100. You can do it because it's a zero coupon bond. So I'm writing 100. 1.04 power 30. So what is the price? What should be the price? That is 30.83. So, but you want to sell it after 25 years. So it means that now the situation is like this: 0, 30. So it means that the price should be 30.83. Okay. So when 5 years will pass, you are standing here, your position is here, right? So it means if I want to evaluate this bond now, so what would be the price? So price would be equal to future value, that is 100 again, and coupon rate is also the same. What should be the discounting period? 25, right? So it means you will calculate two present values. One when you had invested, so this is the present value, and when you are going to sell it. Because we don't know the selling price, we should calculate that. And how did we do that? We discounted it for further 25 years. Now we have two values. One at 0.0, so that is 30.83, and one at the end of 5th year, that is 37.51, and one at the 30th year, that is 100. Okay, so this is the situation. So now you are going to sell it when you will reach at year 5, and this is the year 0. Okay, so the question is asking us, if the bond yield to maturity is 4% when you sell it, what is the annualized rate of return of your investment? So if I ask you what is your return, so it means that this is a buying price and this is a selling price and this is a maturity price, when you will get it, right? So the question is asking us that you are going to sell it at the end of this year. So this is the selling price and this is the buying price. Can I also do it like this? 0 to 5 present value and future value. Can I do that? I'm just ignoring this part because I'm selling it here. Can I do it like this? Future value and present value. Can I do that, students? When you will sell it in the future, so it will be sold at 37.51, but when you buy it now, it is 30.83. Since the question is asking us to calculate the return, so we know the formula is present value is equal to future value 1 plus r power n. The question is asking us how much return will you get? So we need to calculate this r. So PV is 30.83, FV is 37.51, r we need to calculate 1 plus r power n. So if we adjust this formula, so it would be 37.51, 30.83 power 1 by 5 is equal minus 1 is equal to R. Did you get it? So this is the formula that they have written. How did we get this formula? This is future value when you will sell it. This is the present value, and simply you will get R here. Simple calculation. Okay. Now, if the bonds yield to maturity is 5% when you sell it, what is the annualized rate of return of your investment? So similar thing, but instead of 4%, now we are changing it to 5%. So it means the first part we are not changing it because the purchase price when you had bought YTM was 4%. So we are using 44%, and this is our answer. So the answer should not change when you bought it. But when you are going to sell it, instead of 4%, we are using 5%. Our answer is 29.53 return. So this will be the future value now, and this will be your present value. Apply the formula of simple discounting and get your R. So this is your answer. But next, if the bonds yield to maturity is 3%, then what is the answer? Again, 4% will not change. When you will sell it, the rate dropped from 5% to 3%. Our answer is 47.76. Again, this is future value and this is present value, and you will get your answers, that is 9.15. So can you see one thing from this question, that if our YTM is the same when you bought it and when you sold it, okay, so the answer return is exactly the same. You see, same 4%. Are you getting me? If YTM does not change when you bought it and when you sold it, your return will be the same, right, as YTM. Return is equal to YTM. So if it means that if your YTM changes when increases when you have sold it, right, the answer would be lower. So it means that your return is lower than YTM. You will have negative return. Okay. But if your return when you sold it decreases, then you will have the higher answer. So your R will be higher than YTM. Did you get it? So what are the takeaways? If YTM remains the same when you bought it and when you sold it, your return should be the same. Okay, next, when the YTM changes when you sell it, and changes mean when it increases, then you will suffer a loss, and when the YTM decreases, you will make a profit. Okay. The question is saying that even if a bond has no chance of default, is your investment risk-free if you plan to sell it before it matures? Explain. The question is saying that, let's say you bought normally these non-coupon bonds are sold by the government. So when they are sold by government, then there are 0% chances of default. Then what is the risk then? If the bond cannot default, so what is the risk if you do not hold the bond until maturity, means until 30th year? So that is actually changing YTM. Changing market interest rate actually affects, because if the interest rate increases in the market when you sell it, right, it means you will make a loss. So changing interest rate or changing YTM is actually the reason that brings some exposure to the risk. Okay. Next, now we are going to solve the questions for the stock valuation. Okay, Enly Corporation has a current stock price of 27. This is the market price. Okay, and is expected to pay a dividend of $2. Expected to pay mean this is in the future, right? So I cannot write D naught, it will be D1. Okay, so expected mean next period. So for the next period, I'm saying D1 is equal to $2 in 1 year. It's expected stock price right after paying that dividend is 28. So it means when this $2 will be paid, the price that is now today is 27 will move to 28, mean when at the end of the first year the price will be $28. So now can you see that the current stock price is 27. After 1 year the price will be 28, and You are at the end of the first year, you will also get $2. Okay, what is the analyst cost of equity cost of capital? How much of analyst equity cost of capital is expected to be satisfied by dividend yield, and how much by capital gain yield? Okay, so first of all, my advice to you would be, when you see such questions, you see the question is starting from company's name. Can you see that here? Enlay Corporation. So can you tell me whether this is an investor perspective or a corporate perspective? Please be fast. Enlay Corporation. So is it a corporate perspective or an investor perspective? Anyone? Okay. So this is a corporation perspective. So for a company, when it pays dividends, it is called cost. But if the question is starting that you are an investor, you will see that the question will tell you it is a return, right? So since it's a corporate perspective, you will see that it is a cost component instead of return, right? So what is the analyst equity cost of capital? You know, if it is an investor, it would be what is your return on this investment. So when it is cost for the company, but return for the investor. How much of the annual cost of equity is expected to be satisfied by dividend yield, and how much by capital gain? So dividend yield is actually equal to expected dividend divided by current price. So expected dividend is 2, current price is 27. So this is the dividend yield. So it means the cost of the company in terms of dividend is 7.4%. What is the capital gain? Capital gain is equal to the difference of the two prices. Capital gain is equal to P new minus P old divided by P old. Okay, so that is equal to 3.70. What is the total cost of capital then? So 7.41 plus 7.30. So this is the answer. So this is called equity cost of capital. Because it's from a corporate perspective, we are calling it as cost. But if the question is starting that you have invested in this unleased corporation stock, then it will be return on capital, return on equity. Same thing, but different perspective. Next is Ashish Corporation has preferred stock with an annual dividend of 3.15. Preferred stock always have a fixed dividend. So I'm writing DP mean dividend of the preferred stock, that is 3.15. If the required return on the Ashish preferred stock is 7.9%, what is its price? So it's a very simple formula, because the formula for the price is dividend stock is always equal to expected dividend divided by R minus G. Since in the preferred stock there is no growth, so we will use DP fixed dividend divided by RP, mean the return on the preferred stock. So it's a very simple calculation, 3.15 divided by 7.9%. Our answer is 39.087. Since growth will be 0 in the preferred stock, there is no growth. It's always a fixed dividend. Okay, so it means we are applying the formula of dividend growth model. I mean the same formula, but for preferred stock, since there is no growth, so we are just using these two components. Okay, any questions so far? Okay. Now, CX Enterprise, again, a company perspective, has the following expected dividend: 1.08 in year 1. So let me draw it here. So it means in year 1, or D1 is 1.08, 1.18 in 2 years, D2 is 1.18, and 1.27 in 3 years. D3 is 1.27. Since it's a stock always have an infinite life, right? Okay, after that, means after this year, its dividends are expected to grow at 4.1% per year. So it means from here the growth rate is 4.1%. okay, forever. After that, it's for forever. So that its forced dividend will be 4.1% more than 1.27. Of course, after that, dividend is going to grow at 4.17, so it will grow at the rate of 4.17. So we will use this D4 will be equal to 1.27, 1.04. Okay, so it will grow. So the answer would be 1.32. Okay, after that it will remain constant, so for forever, so we are not bothered. Okay, so if CX cost of equity capital is 12%, what is the current price of the stock? So R is equal to 12%. We need to calculate the price. So this is a phase growth model or a variable growth model question. Okay, so what you need to do is when you see these questions, so you will remember one thing. Okay, you need to remember one thing. So when you see this question, you will apply the growth rate from 1.27 and you will get your answer here. So that is 1.32. But you need to do one thing because the growth rate happened from year 3. So you will apply the formula here. So the formula would be constant growth model. P at year 3 is equal to D4, which is equal to D3 1 plus G, right? Divided by R minus G. Okay, so because the growth has started from year 3 and you are going to get D4, and that would be an extra, that will be a higher dividend compared to this one. So that's why we are using that. So it means that from year 3 the growth happened. So at this point, the year from where the growth has happened, you will stop there and you will calculate this P3. So it will be 1.32 divided by 0.12 minus 0.04. Okay, so you will get answer of the price. So the price is equal to 16.73. Now let me draw this timeline again for you. So it will be like this: 0 at year 1, you will have 1.08. Okay, at year 2, you will have 1.18. At year 3, you will have 1.27. Okay, so this is D1, D2, D3, and we also have D4 here. So I'm writing D4 here, and that is 1.32. It is for forever. So it means that since it is for forever and the growth had started from year 3, so you have used this formula, and your answer at year 3, you will also have your another answer, that is P3 is equal to 16.73. Okay, so it means that at year 3, from where the growth had started, you will have two amounts: one, the dividend of that particular year, as well as the price of the dividend growth model, constant growth model. So from where you actually started. So it will be P3, you will use D4, R minus G, and you will get this answer. Okay, so it means that from here now you will discount, you will calculate the price. So you will discount this one for 1 year, you will discount this year, this dividend for 2 years. Okay, you will discount this dividend for 3 years. You will also discount this price for 3 years. Okay, so if you even add these two together, you can also do that, but as you can see from here, so you have calculated P3. So it means 1 year, the year from where the dividend constant growth had started, you will calculate the P3 from there, and you will use D4, not P3, D3, and this is your answer. Okay, so once you get this answer, you see that 1.08 is D1, D2, then D3, and then P3. This is your answer. Okay, so remember that you are not going to use P4 because the growth rate started from year 3. Okay, so this was a constant growth model. Next, we are going to use total payout model. So total payout model because is used when companies, they both pay dividend as well as they also incorporate capital gain. Okay, Suppose Comco system pays no dividends but spent 5 billion on share repurchase. Okay, share repurchase is also another form of distribution. So sometimes companies they pay dividend, it's a cash dividend. Sometimes company also pay share also do share repurchase. So when the companies they do share repurchase, the price of the shares it increases because the distribution gets lower, right? Last year, if the company's cost of capital is 12%, and if the amount spent on the repurchase is expected to grow by 8% per year, estimate Comco's market capitalization. If Comco has 6 billion share outstanding, to what stock price does this correspond? Okay, there are two things that you need to remember. When we apply the total payout model, it does not give you the direct answer of P. It will not directly give you the answer of P. First, it will give you the answer of market capitalization. Then you divide it by share outstanding, and then you get this price. Okay, but the dividend model or other model, they directly give you the answer of price. So it means that we will get the price from the total payout model by two stages. First, we will calculate the market capitalization, then we divide it by 2 by share outstanding, and then we will get the price. So last year it was 5 billion. So it is expected to grow at the rate of 8%. So 5 billion is the share repurchase and it will grow at the rate of 8%. So if you apply this formula, so it means next year total payout next year will be 5.4 billion. Okay. Now, so this is similar like to this. So previously we were using dividend. Now, since it's not dividend, it's a share repurchase. So it is SHRP. Okay, so it has grown by 8%. So how much they are going to pay next year? $5.4 billion. Okay, so what is the equity value? So what do we need to do? P is equal to, we know it was D R minus G. Since D is not here, we have SHRP, share repurchase, R minus G. Same thing, but we are using SHRP. But this is not equal to P, this will be equal to value or market value or market capitalization. So this is 5.4, 12% minus 8%, 135 billion. So the total market value is equal to 135 billion. So how many shares does this company has? If Comco has 6 billion share outstanding, to what stock price does this correspond to? So total number of shares are 6 billion. So 135 divided by 6, the price is 22. As you can see here, first we calculated the total market value and then we divided by total number of share outstanding and we get our answer 22.50. So remember this thing. So this is a total payout model. In the total payout model, some companies they do share repurchase because they do not fully distribute in the form of dividends, and some companies pay some part of their funds as dividend as well as share repurchase. So that's why we apply the total payout model. In my lecture, I already have explained this in detail, so you can see watch the recording. I know that you might have not watched the recording, all of you. So after our test one, you can watch the recording, and I have explained these topics in very much detail.